All right. Good morning, good afternoon, good evening, ladies and gentlemen. We are 1 minute away from the market open. Let's see where the market takes us today. Now, I think the thing that we really want to talk about today is what do credit yields or credit spreads actually tell us about the bond market, what the bond market basically thinks of the economy, and I think how that affects the portfolio companies that we have. So today, I mean, we are down from where we were yesterday, uh, but let's see where does this take us. Okay, so I believe it's 9:30. Markets are open. Let's see what is happening to the different companies in the portfolio. So S&P is down 0.5% today. S&P is down 0.5%. I believe so. S&P down 0.5%. The Qs are down nearly 1.5%. Let's call it 1.5%. The Dow is down 0.3%, and the Russell is down 0.5%. So what we have actually that has happened over the last couple of days um, is the 10-year going up to 4.74, the highest level it has been in 30 years. So naturally, I think that is something that is putting downward pressure on equities at the moment. But again, let's take a look at what's happening in the markets right now before we move into that. So if we take a look at our core positions, we have SoFi down around 2% on the day. And I think that's only natural with where bond yields are sitting. We have already said that a very high possibility yesterday after showing a lack of strength on a day where they did get upgrades, where they did see some positive momentum. I think they failed to actually retest the 50% FIP. So I think that's actually a little bit bearish. Shows that there is some selling pressure still in the $18 ranges. So that's why we are seeing a dip again here. And I believe we will retest the top of the range. And if we can actually bounce off 1750, that would be pretty bullish for the short to medium term. Bitmine is down 1%. Again, we are trying to break past the 100-day moving average. We closed above it yesterday, but today it seems like we are struggling at that level again. So yesterday we explored the MNAV of Bitmine, and Bitmine was actually, I believe their net asset value was around 1850. So we are probably just under a one times MNAV right now. Zeta, okay, so it seems to have found a little bit of a peak at 29.90, and we are coming down somewhat. Hood is down 3% over here. Core weave down 6%. I don't think the core weave move down is something that people are surprised with. They get up on earnings, so it's only natural that I think we see them kind of close the gap over here. So for those of you who might be looking at an opportunity to get into CoreWeave, I do believe you'll get an opportunity pretty soon. But as we have covered yesterday, the numbers that they put up are actually pretty strong. So in today's stream, we're going to do something slightly different. What I actually hope to do is to actually talk a little bit about bond use, how that affects the market, how that affects the AI trade, basically. Then we will talk about the individual companies that we have, what's happening around those companies recently. And basically, I'll end by taking you through, like on the spot, because I've pulled up the documents, I haven't really looked through them. But just want to look through a couple of companies that I've been pretty interested in preparing for this upcoming volatility. All right, so let's take a look. SoFi. So SoFi is basically struggling to get past 18 right now. We are at 90, 1790. I think one of the things that has caused this volatility, this early morning volatility, uh, is really I think Trump saying that he's not planning to extend the like he's not planning to renew the MOU with Iran. I believe I saw that on Bloomberg. Give me a minute. Okay, so even Bloomberg News is talking about the 10-year. Hmm. I don't think you guys can hear this, right? Okay, so the breaking news that we have is Trump actually saying that all the mines in the Strait of Hormuz have been removed, but more on that later on. Zeta is now down 1%. Hood is down 3%. We are seeing a little bit of a bounce from the low of the morning. CoreWeave is down 6.5%. I think CoreWeave can really get down to the low 90s or high 80s. ASTS $67. Nvidia down 1% and Grab down another 2.5%. So the only thing green in the portfolio today, morning to now, the only thing green in the portfolio today is really ServiceNow. Uh, Again, I was talking about this company recently. This is one of those that I'm likely going to use as a hedge in the portfolio. Viper Energy. I'll be going through the financials and all that later on stream, so that we can basically take a look together whether or not it actually makes sense and to try and understand what they do. But I believe they own a large. They are like a royalty kind of business, and they own a large part of the Permian Basin in the US. All right. So what? Let me pause. I'm getting a little bit distracted by the Bloomberg news, but basically we have Gabriela Santos, J.P. Morgan Asset Management. I think you guys should be quite familiar with her. She is basically commenting on the same thing as what we want to talk about today, which is basically the higher bond yields, putting a lot of pressure on equities. That is exactly what we are seeing. There's two pieces of news that came out recently that I think it's important for us to that I think it's important for us to actually talk about. And I think it also signals that perhaps the Federal Reserve doesn't really need to do anything in September. Like, what's the chance of the Fed rate hike? Let's take a look. Let's see. Fed watch. So if you take a look over here, I think the chances of a September cut should be very low, and I think the markets are kind of doing the job for them. And the markets are also signaling. I mean, based on yesterday, what's the 2 year today? The 2 year is at 4.18. The 10 year is at 4.7. So the spread is widening a little bit. I think it's kind of doing the job of the Fed for them. So right now we have a 60% chance of no hike, which I think would be definitely bullish for stocks. Give me a minute. Yeah, I think that would be bullish for stocks. I don't think we want to see there be a rate hike. I think right now with the data that we are getting, if you listen to, and I'm going to play the clip for you later on, you're going to listen to Liz Thomas from SoFi talk a little bit about warmer inflation, talking about how the hike doesn't really do anything because the hikes, what they do is they try and curtail demand, but this is more of a supply problem rather than a demand problem. And hiking will not, solve the inflation problem, will not magically open the Strait of Hormuz, will not magically produce AI semiconductor chips. So these are things to consider, like the nuance of the discussion. It's not just that this is a inflationary market, but we just have to. I think it's still something that we have to pay a little bit of attention to. But the 10-year, I believe, just made a new high. Let me take a look. We are at 470, 472 right now. 472. If I go back to, yep, so we peaked at around 5.0 back in October of 2023. Uh, and we kind of just and we have kind of broken above the wedge, which is not a good thing. I'm going to show you what I'm seeing over here. CoreWeave down 6%. Yes, I mean this is not surprising considering the kind of run that they had. So for those of you who like the earnings, felt like you might have missed out, you might be getting a chance over here to get another opportunity. But this is what we are seeing over here. This is basically the high of 2023. I think before that, you don't even. The last time you get to 5.2, we were in '07. So this is really historic highs. Apart from 2023, we are seeing that the last time bond yields were around these levels was back in '07. So I think there is a little bit of concern. I think if anything, this is what derails. When I say derail, I mean perhaps for the short to medium term, the AI trade. Right now, with the deal that Jensen just signed with, or the memorandum of understanding that he just signed with uh, some of these big financial companies, I don't think that is likely to be the case. But if this continues to go up, don't be surprised to see more downward pressure. All right. Uh, let's see what's happening in the markets today. If we are taking a look, okay, so the some of the companies are bouncing back from the earlier dip from market open, but I do not expect this to last. We have higher bond yields, that has been the focus. We also have Trump saying that he's not going to renew the memorandum of understanding with Iran. We also have Trump basically saying that he's basically strong arming them in a sense. He's trying to claim that the Strait of Hormuz is already Americans' territory. They have already demined the area and things like that. Whether or not that's going to get Iran back to the table is a completely different story, but the energy sector definitely is not liking it because oil prices are at $91 per barrel. Then you combine that with the high yields that we're seeing. Wow, that is really a recipe for disaster. So yes, I mean you're right to say that Iran really has nothing to lose. I think Trump and the US has more to lose from this war than Iran. Like if you really corner in somebody, until they have nothing left to lose, then they will really fight like they have nothing left to lose. So I think that's exactly what is happening right now. Uh, it's more of a game of attrition, and I think Iran is just trying to bring down as many people as they can. And yes, that is true, right? You have a military in Iran that doesn't care about its people. I mean, they just killed over 30,000 of their own people earlier this year, so you can tell what kind of you know you can tell the kind of people that they are, the military folks. Let's see. So far, um, if I actually dive into the daily candles, we are kind of the good thing. It seems like we are forming a little bit of a green candle over here. We are still down from yesterday, but we are bouncing up from today. I'm not sure whether this will last. I just think that over the next couple of days, we might see a retest of the top of the range. If we hold and this 50-day moving average, and we hold around this area, around the 50-day moving average and the top of the range, that would actually be a good sign. We might be starting to see a little bit of short-term bottom over here, and then I'm hopeful that we can get to retest the $22-23 ranges. Similarly for Bitmine, I think nothing much to say. This is quite straightforward. We are testing the 100-day. And I think it's a good thing for Bitmine to take a little bit of a breathe in the last couple of weeks. You can see that since it hit $12, it's been nearly straight up. So I think it's good to see. I mean, since from $12 to $18, that's a 50% return in just what 6 weeks, 50% return in 6 weeks. So it has made a pretty strong recovery. And I think it's healthy for the RSI to cool off a little bit. The only unfortunate thing is that yesterday we were above a 1x MNF. Today we are not. So they cannot be going out to raise money today. Right. Zeta Global, this one seems to be holding strong. We are not seeing them really, falling, even though the markets have been weak. Actually, in the last couple of sessions, we saw that despite the markets being weak, Zeta actually held on quite well. So they have been hovering around this $27 to $29 range, which I think it's healthy. If they can form a little bit of a base over here around $27, that will be fine. My personal bias is for them to drop below $27 for a while, so that my covered calls don't get called away. But I mean, if we get closer to when is my covered call expiring? My covered calls are expiring 4th of September. So that's like what, in 2.5 weeks? Maybe sometime next week or the week after. I might look at rolling them out over here. I receive $1.05, if you can see. Right. So technically my break even is $28.05. We are slightly above my break even. It's not too bad, but what I would say is that if this is really the case and these shares do get called away, I am just going to just buy them back straight away, right? But likely I will try and roll these out. But I'm just trying to get as much theta as I can. Which there's not much theta left, to be honest. If we are at 278, yeah. Thinking of writing covered calls for September 21st at 30. Yeah, but I have one. Okay. Close my position, move it to my tax saving account. Oh yes, I mean Zeta has definitely been a volatile company for sure. Our assets are now 31,000. Okay, they dipped to 131,000. They dipped to 130,000 earlier on. So Zeta back in the green today. Robinhood just down 3%. CoreWeave is still down 6%. I don't expect this to abate anytime soon. I think we will continue closing the gap. At the very least, I think we get to $92, $93. That's where the 200-day moving average is. Maybe if we're lucky, you can get it over here at around $90 per share. Now I'm totally out of money, or more or less out of money in this public account. I still have around $50,000 in a personal account, so I might add a bit to CoreWeave at around $90. Just another 100 shares or so. Okay, ASTS. This has rejected the. This is something like I know, and I saw it, and it just slipped my mind, but it rejected the 50-day. I could have trimmed it yesterday. Completely forgot about it. Yeah, because I'm not liking this technical setup. Like I saw it yesterday at 72. I reminded myself to trim this position, but I forgot. Honestly, I forgot. I went to the gym and came back and I slept. So Nvidia down 2% on the day, right? And this is after they announced the Ohio deal, right? Yesterday. Was it after market close? I can't remember when I saw it. I saw it this today when I was preparing for the stream. And Grab is down to 347. So again, happy that I trimmed and added to SoFi and ASTS when I did. ServiceNow up 2%. This might have to do with the Silver Lake Workday deal or potential deal, Workday. Yeah. So you can see Workday really ran up since April, not even April, since June 25th. This has nearly been a double, nearly a double, around 80% since then. So I think we are seeing a slight rotation into SaaS right now. Are we? Let's go and take a look. AI applications. Uh, we have Rubrik up back over $100. That's fantastic. Zscaler, CrowdStrike, Reddit, Sentinel One. Lawrence must be happy. Still up 2%, $22. Fantastic buy at $13 from him. Okta, Sirens, Lemonade. Lemonade is still $50. Huh? I mean, they are kind of at, I wouldn't say they are very oversold, but they are at oversold levels. UiPath, again, today we are seeing them down 1%. I think nothing surprising over here. Likely, what we will see with UiPath is that they will dip down. There will be some sort of confluence between the 200-day and 50-day when there's a crossover. If they can bounce off from there, I think we can see UiPath at least retest the highs of $18, $19 over here. Okay. Ulster, this was the name that we were talking about a couple of weeks back, ran all the way to 63, dipped back down to on July 30th, dipped back down to $31, and basically back up again in at around $44. So this one has been volatile. Yeah, I think you can see today primarily the software names are red. Netflix from 65 all the way to 77. Okay, it's been a good run for Netflix. Netflix is just not really for me. I own Ulster. Yeah, great returns. Yes, returns has been pretty fantastic. AppLovin. Okay, this is something that were you the one that raised it yesterday, Kunal? But this is something that after the recent dip, I'm looking at it again. So when it dipped here at 350, I didn't have time to look at it. That was like in March, right? So I stopped looking at it because I thought it was going to recover, and it recovered all the way back to 600, sorry. But the recent dip has given me a chance, and basically right now we are getting to buy it at $100 billion market cap, which is the same price where it was back in November of 2024, so 2 years ago. If I just take a look at the income, so in Q2 of 2024, they basically did around $700 million in revenue. And today they are at $1.9 billion in revenue. So during that period of time, their revenue has more than 2x. It's very close to 3x. I think a 3x will put them at around $2.1 billion. So they're just under 3x in terms of revenue, and yet they're trading at the same price as they were back in 2024. AppLovin target mobile game ads, so doesn't encroach on Zeta. I think I will be dedicating most of tomorrow to look into AppLovin. Yeah, I think what I'm trying to do to get into a habit of is at least on stream once or twice a week we will deep dive into a company. Today I was just trying to set up the stream, trying to prepare some of the stuff I want to talk about around bond use and things like that. The research part, I think I underestimated how long I think I'm quite a naggy person in general when it comes to researching about stocks. So because of that, I didn't get the entire research done, but you know what? I will just do it live on stream later on. But yes, AppLovin is definitely on the list. UiPath is something that Lawrence has put on my radar. So I am looking into it so that I can prepare to at least take a position if I do find that I like what I see. I think I need to get a little bit more first-hand understanding of the product, right? And to see how it works. So because the way that I think about it, like Palantir can do what they do. So does that mean that they are only like approaching the small, medium enterprises? Is that their market? Because SME may not be able to afford a Palantir, right? So then maybe they use UiPath. I don't really understand the nuance of their product fully yet. Uh, I'm just looking at UiPath purely on a price action perspective. Intuit up 5%. I think you can see today a lot of the software names are up. Salesforce up 3%. Their earnings are soon, are they not? Am I mistaken? I think their earnings are soon, right? We have Nvidia next week, Broadcom the week after. ServiceNow up 3%. What are we doing? Okay, we kind of like came back into the wedge. Okay, let's see what happens with ServiceNow. At least we're bouncing up. Cloudflare, Datadog. Yeah. Duolingo. Okay, I mean, anything that basically bottomed in April has been a pretty good buy for software. Even Duolingo hated, but this is up what 60%, nearly 60%, right? From nearly 60% all the way from April. Give me a minute. So I think I think what we have right now really is a reaction to yield, and I believe uh the Japanese also increased their yields, I think. Yep, the 10-year Japanese government bonds. Okay, let me show. So one of the things that I have been Japan's 10-year yield hits 3-decade peak on inflation worries. And I think this is the very similar story that we are seeing with what's happening in the US as well, right? So the rising Japanese government bond yields and the strengthening Japanese dollar or the yen, so it presents a little bit of I mean, it's like the yen carry trade 2.0. I think people are generally worried about that, right? So let me see. This is basically the yen carry trade 2.0, or that what people are worried about, because Japanese capital has kind of been like would you call it that, like the primary engine for global liquidity for quite a while. Of course, with tighter monetary policy, then that will actually compress the spreads. Then that will not make some of the trades as profitable, right? So people will try and exit them. They will need to actually be paying back a higher yield. So you know it's basically a cascading effect. Then you have the US 10-year being at all-time highs as well. You're being squeezed from every side. And this entire volatility that we are seeing is basically the bond markets being fussy. And Tom Lee did say this. He did say that the markets will test the Federal Reserve chairperson. Kevin Walsh came in. He has had 2 press conferences, right? And I think the markets are still getting used to his style. So let's see over here. In this article on Channel News Asia, Japan's benchmark 10-year government bond yield climbed to a 3-decade high on Tuesday as a stalemate in the Middle East conflict stoked inflation worries and reinforced speculation around a near-term Bank of Japan interest rate hike. So the 10-year JGBU added 1.5 basis points to 2.935%. Okay, after touching 2.94% for the first time since September 1996. We are going back 3 decades. Anybody in fixed income this year, you have been absolutely smashed. I'm so sorry. And I'm saying that with somebody who has money in fixed income as well. The good thing is that if you dollar cost average into fixed income, your yield is going to be quite tasty. Do you want a 6% yield? I think if you believe that all of these things is going to work itself out eventually, 6% yield, pretty decent, right? If you're a little bit worried, uh, yeah, I think you might want to look basically have yields of different duration, so you can take advantage of both the short tail and the long tail. Following the auction result, the 5-year yield reversed early to decline 1 basis point. It started the okay. US analyst raised forecast. Okay, so DBS analyst raised forecast for the 10-year Japanese yield to reach 2.85% by year end, and now expect the BOJ to raise the key rate in September while accelerating the pace of tightening to 1/4 point move every 3 to 4 months for from about twice a year currently. So they are basically expecting 4 hikes from 2 hikes in Japan. Uh, so liquidity is going to be tightened, and I think that's going to cause a squeeze, not in a good way. Like it's going to really constrict the liquidity in the US markets as well. Government appears less opposed to an early hike. I think this is more of an opinion. I don't know whether or not this is true. I think the government has the Japanese government has been pretty cautious, but let's just see how. I think September is going to be a very interesting month. That is why I have so many covered calls for September. Yesterday, I think it looks the move looks very good right now because just I basically closed out the entirety of my BMNR covered calls and then basically opened new ones at 49 cents. So I'm not too sure whether or not I think I should talk about this now. I'm not too sure whether I mentioned it on stream because I had to take out some money from my big account for renovations and stuff like that. I ended up withdrawing over 6 digits for various things that I have to pay for over the next couple of months. So from 500,000, the capital there is now only just over 370. Not as big, but that's because I just have to pay for certain stuff. And I expect there to be a little bit more money coming in across the next couple of uh, months from various sources. But with that being said, where is it? Oh, that's not the one. I think you can see it better over here. All right. So what we actually did, if you take a look over here, SoFi position, our cost basis around 1507. Okay. Why we are 1507? Because since last June, we have basically realized around $31,000 in premium. SoFi has been pretty consistent. There has been very little instances where we had to roll. There was one instance recently where SoFi tested $20 where we had to roll the covered call for a little bit of a loss. But since then, more than made it back. So we have closed the more recent covered call over here. When did we close this? We didn't close this on 18th of August. Let me just double check. I think we closed this SoFi by when was this? 3rd of August. We closed this on the 3rd of August. So what you notice is that okay, so for SoFi, it's still been pretty regular. We closed this on 15th of May. Didn't really do much between May and June because the covered call premiums were not there. Then we had one over here. We sold covered call and then we closed this on 31st of July. And then we also had one sold on we didn't close this on 31st of July. When did we close this? I think my dates are a little bit mixed up. Let me just double confirm. SoFi, SoFi, SoFi. We close this on 8th. Okay. So we close this on 8th of July. Right. So we open this immediately after we close. Right. Okay, so this makes sense now. We basically closed this. We didn't let it expire worthless. We closed this at around. Oh, I just realized this is so small. Okay, so basically, how you read this is that in May, we basically sold a covered call, 10 cents. We closed it at around 7 cents, and we closed it pretty on June the 15th so that we could open another one. And then we sold a 36 cents covered call over here. And thankfully, that actually worked out quite well. We closed this at 14 cents on July the 8th, opened another one, 36 cents, and then we closed this on 3rd of August, just after their earnings. So that has actually helped us to make up this road position over here. And currently, right now, we actually have a sold call open for 18th of September. I believe this is we received 25 cents for that. Let me just take a look. How much is this worth now? This is worth around 10 cents. So we are around 60%. We're sitting on 60% profits right now. Sometimes when I feel a little bit worried about the stock running, I might take profits at 60%. Usually I take profits between closer to around 70-ish percent, 70, 75%. So I'm not too worried about this right now. I mean, if you look at the price action, if you look at the market that we are in, I don't think SoFi is getting to $23 by 18th of September. If I'm wrong, I will be very happy because I will be nearly $100,000 richer in this account. So that is all good. Now, so that's SoFi, and then with BMNR, you can see that BMNR has done pretty well as well. One of the things that I've tried to be a little bit more disciplined is over here. You can see in the past, a lot of the times I like to let the options expire worthless, but this year I really tried to be a little bit more disciplined with with my covered call strategy. Sometimes I tend to be a little bit greedy and just try and let it expire worthless, but I've let it close out um at 70% profit, or if it's 14 days out. So usually I run that tasty trade strategy, 45 days covered call, close it with, I think, close it after 21 days. So if I sum up all of this, you can see over here that this is around when I started. If I sum all of this up, I've made around $10,000 since the 31st of March to where we are today. So if you count March to September, it's basically what, 6 months, $10,000 in 6 months. That is over $1,000 in cash coming in every month, just sitting around doing nothing. With IV so low, don't you find the premiums really bad right now? I do. But the reason for me selling covered calls and all that is not to milk the premium. It's because I want to hold on to these companies, and I do not want to go back to a proper 9 to 5. So I have volume in a sense. I have 13,000 SoFi shares. I still have 60,000 sitting on the sidelines. I have 3,000 shares of BMNR, which I'm squeezing. I'm using the $50,000 as collateral to sell cash secured puts on BMNR. And then at the same time, I'm also selling covered calls over here. So you can see the BMNR position is made up of a sold put and a sold call, right? So the sold put is at $17 today, coming under a little bit of pressure, but that's perfectly fine. So call yesterday, I actually, if you take a look over here, I actually closed this call yesterday on 20th August, and I opened another one. I don't believe it's 2nd of October anymore. I believe I did a bit nearer. I did 18th of September. So this is 18th of September, $23. And basically right now, this is what, for 42 cents. Is it 42 cents? 44 cents. So this is the setup at the moment. I actually had a call and a put expiring like a direct strangle all on the same day, but I closed the covered call so that I can get a little bit more premiums as I rolled it out to September 18th. The reason why I did not actually roll out the cash put is because I really wouldn't mind buying another 2,000 shares. I sold it off initially because I wanted to fund some of my renovation costs and things like that. But since I'm able to get a bit of cash, I have 60,000 sitting on the sidelines. I am not going to just uh, I'm not going to just buy it at, $18, $19 where it was the last couple of weeks. I would just keep selling covered calls until they get assigned, right? So I try not to own that many stocks all the time, so that I can keep a concentrated position, and then I can, although the volatility is low, and for me in this portfolio, I'm even more conservative. I don't even sell at point 0.3 delta. I usually sell at point 0.2 delta for this portfolio. And when I'm doing that, it's although the premiums are small, but because of the volume, it's pretty decent. Morning, Riaz. Nice to see you here. So, for example, for me, in terms of the SoFi position, you can see over here, this month, the premiums are not as juicy, but last month they were pretty okay at 36 cents. So 36 cents, I multiply by 130 is still for 4,600, so close to 4,700. And at least in Singapore, because we have a conversion rate, it's still around $6,000 dollars per month in Singapore, which is actually well above our median income. So I'm just sitting around doing nothing for SoFi, selling covered calls at 15 to 20 delta, and I'm getting above median income doing this. So for me, this strategy works. I think it's very specific to my location. I have the privilege of being in Singapore where I have no tax obligations around covered calls when they get assigned and things like that. That's number one. Number two, the options income don't even count as income. It's not taxable income in Singapore. So that's the second thing that makes this strategy worthwhile for me. And I think it helps fund me being able to do my research and not worry so much about my day job and stuff like that. The only downside is that, like, in this next couple of months, because moving to a new place, I will need to pay for renovations. I might need to change my car soon and things like that. I have to use some of my capital, so the income will fluctuate a little bit. But by and large, the way I do this is I pick companies that I love. I don't mind the low volatility as long as I can do volume. So I compensate high volatility with the lower volatility, sorry, with higher volume. Ondas makes another acquisition today. Let's see. Granted, they're not as they are still attractive. $5 billion market cap. But wow, they are an expensive company. I just realized they are $50 million on a trailing 12 months in 2025. Trailing 12 months, what is their, they do have a lot of cash though. $500 million in cash, $550 million in cash. Did they make the purchase with stock or with cash? I mean, the market doesn't seem to be punishing them too much. Yes, Texas. I think really people in Singapore don't realize how fortunate we are. We probably have one of the best access to the financial markets anywhere in the world. I think comparable with Dubai. I believe Dubai is also tax free, so we don't get taxed on capital gains. Even my options income is tax free. So I think that really helps a lot. I'm not too sure whether that's the case all over the world. Is options income taxable for you guys? It's an all stock purchase. No, but even then, the dilution, the people don't really seem to be taking them down much. I think what we are seeing right now is just a bounce off the 50-day, and they do have a volume profile. I see over here from the volume profile, they do have a shelf over here at around 770. So I think that will act as a pretty good shelf, and it's worse because they consider it's capital gains. All yeah, that sucks. So yeah, time to move to Singapore. No, I never realized what a big advantage that is. Like I don't have to think about taxes. Like whatever I make, uh, is basically whatever goes into my bank account. For sellers, you get taxed on the whole premium until you close it. Man, that sucks. No, I believe maybe one day Singapore will become like that, but I think investing is still not a big trend or not a big phenomenon in Singapore. So not many people do it. I think a lot of people say they invest, but uh they kind of have a couple $1,000s inside some index funds, but they don't do it regularly enough. So it doesn't make sense to tax. And at the same time, we can attract foreign investors to come into Singapore that way. Whereas what gets taxed super heavily in Singapore is our property. But somehow or other, I think it's just in the culture. Asian people love to buy properties and love to own properties. So I have a number of friends and clients even that I think they misjudge the strain of owning a property in Singapore. It's not that they can't afford it; they can definitely afford it, but do they want to afford it? Right? Like what else they have to give up in order to afford the property? But yes, land is king. Unfortunately, in Singapore, I mean, if you know, in Singapore, because we are so small, right? We are land scarce. Almost none of our housing is freehold, which means that we are all technically leasing the housing from the government. We don't actually own it because everything has a 99-year lease. So, so the problem with the land is king thing is that we have no land in Singapore. Which is why the taxes are high, which is why the government has to regulate it the way it does. So it's not their fault, right? That Singapore is small. But since that is the case, I really do not understand why people are willing to pay so much for something that you don't even technically own. It's like you're trading in cash or stock deal. Not sure what that means. Okay, maybe the okay. I'll have to look into that. I like to Ondas in the sixes, but in the eights, I need a little bit of margin of safety for me. I know they went all the way up to 15 last year. I mean, that looks nice, but yeah. Yeah, but I mean, unfortunately, that's the only thing you have. We are mostly like Singaporeans, 93%, I think. Is it 93 or 96%? I can't remember. It's a very high percentage. We are all homeowners compared to like in the UK, in Australia, where I grew up, or in the US, like people don't mind being renters. In Singapore, it's not really a thing. Like hardly anybody are renters. People who rent generally are expats or like foreign workers. Voyager. Why is that name so familiar? Was this a Chamath spec back in the day? Am I mistaken? 2.5 billion dollars. Was this a Chamath spec back in the day? I have no idea. I don't think so. I don't think I no, I do not believe I've really looked into this company at all. What's on my space name? Do I have space in this account? My space names are Rocket Lab over here, ASTS, Kratos. Okay, I combine robotics and space. Symbiotic, Redwire, on this. I have no idea what Global Medicine is doing here. I don't really pay attention to the rest of the segments here. I usually use Mumu more than Weibo. Like Weibo is not the best in Singapore. it's just easier for me to move my capital in and out. Let me share this instead. Yeah, $42. No, I've not heard of them. They IPO. Okay, so they're not a spec. They IPO last year. No idea what they do at all. Zero idea. Uh, Financials. Let's take a look. $36 million in revenue last. No, sorry, $52 million in revenue last quarter. So on a run rate of, let's see, this is 80 plus 40, 120, 120. They're at 170 million in trailing 12 months. They are trading at what, 2 billion? So nearly 11 times, 12 times sales. Speculative play on space defense. Sounds like the Avengers. I've been trying to catch up on the Avengers before Doomsday, so Voyager is Shield but in real life. Okay, give me a minute. Let's go back to okay. Sorry. For a moment there. Okay, so let's cover a couple of things that I want to talk about before. Okay, so this was the Bloomberg article that I was talking about. Global bond slump sends long-term borrowing costs to the highest in decades. We were just speaking about this earlier. The 10-year rose to 4.74, I believe, earlier today. Right now, it's falling a little bit, just slightly, to 4.71. Not enough to really say, yeah, this is a reversal of the trend. I think this is, yeah, you can see this. This is not what we want. And unfortunately, this has been going straight up since it bottomed back in March of 2026. So this has gone from 3.9% in March of 2026, basically right at the start of the Iran war. On the day of the Iran war, this was 3.9. Right now, we are at 4.71. So I think that is going to be the next fear cycle. I believe that is going to go through the markets. And right now, the entire thesis over here is that all of these companies, especially the Mac 7, if you actually follow the recent article, $3 billion of off-balance sheet lending. Let me pull up the article for you. $3 of off-balance sheet lending is basically causing a little bit of a concern among investors, and I think that it is a real concern. But I didn't realize it was $300 billion. Give me a minute. Where is it? Where is my 300? Is it here? Off balance sheet debt. Where is it? Oh, $3 trillion. Is this an exaggeration? We are seeing this uh happen in this has been reported in Yahoo Finance and also in the Wall Street Journal. Can you hear me now? My mic just disconnected for a moment. Okay, now I see the pickup. Can you guys hear me? Okay, fantastic. I'm not sure where my mic started to disconnect. It wasn't even muted, it was just disconnected. I think I must have pulled onto the cable. But basically, what I'm saying is that in the past, or at the start of this AI build out cycle, we are seeing all of these hyperscalers build up, right? Go on this entire build out of the AI infrastructure through their cash from operations. Right now, we are projecting that a lot of these hyperscalers, a lot of the Max 7 companies, their cash from operations are going to turn negative in 2027. Some of them have enough cash on their balance sheet to fund the continued build up, but companies like Meta, especially, they have worked out deals with Blue Owl Capital, with companies like that, to get some off balance sheet financing. So when you look at their balance sheet, it looks very clean, but of course, when you dig a little bit deeper, you are going to see that they do have some of these off balance sheet risk that I believe the higher rates are going to uh, I did follow at Zitron. I mean, I saw his story. I don't really follow him very closely per se. Until last week, I believe on Basis Points, I saw Amit saying that he doesn't actually have a background in finance. I never knew that, so I have to look more into that. But yes, the amount for AI spending is really going into, like, I think even if we are in a bubble, we are still in the early stage of the bubble. But again, that uh, you know, are you in a place, or is your portfolio in a position where you feel comfortable playing this merry-go-round? I would say that personally, I'm not as comfortable with this merry-go-round. So, yeah, I am open to be a little bit more conservative. Yes, of course. So the thing is, if they turn off capex, they will be fine. But if they turn off capex, then the entire semi trade collapse. So I don't think the Max 7 is a problem. Like, invest in Google, sure, by all means. Uh, exactly. Companies like the Neo Clouds, companies uh that I really, really do believe that in the Neo Cloud space, it is going to be winner takes most. I don't think there will be no need for Neo Clouds, but I don't think there will be a need for that many. I think there will be a consolidation. Uh, my gut feeling, it's like you are probably going to end up with companies like, it's going to be a 1 and 2 between Nebius and CoreWeave. Even Iran, I'm not too sure. Uh, I haven't dug too deeply into Iran, but for in Iran's case, one of the issues that they have is that because they are, yes, they own the power, yes, they own the land and everything, but their system is set up to be air cooled, if I'm not mistaken. If their systems are set up to be air cooled and that cannot handle the newer chips, then that might be a problem for them scaling. It really depends. Yeah, so I think I don't think the Neo Cloud space is uh ever expanding TAM. I think that it's going to be a winner take more space, and that could mean Nebius and CoreWeave, maybe both of them. What kind of market share still remains to be seen. I'm going to play this video very quickly for us to have a listen, and then I'll jump back in at the end.
My balance sheet, right? I have that commitment. What they're doing is sort of like more creative financing. And this is like the NVIDIA commitment that was just announced for $500 billion. The example that the journal gives, and just give me a second here to walk through it so people understand what we're talking about.
It's complex.
They give an example of the Hyperion project. This is a Louisiana data center that Meta is building. But they don't own the project. The project is owned by a special vehicle. Meta owns 20% of that vehicle, and the private credit company Blue Owl owns the other 80% of that vehicle. Then there's another company called Beignet Investor. Beignet, of course, the delicious donuts that they sell in New Orleans. Beignet holds the Blue Owl portion, and also raise the financing through the debt sale. So that debt, in this case, is held by Beignet. The lease payments, when they finally do have the thing built and Meta's in there, the lease payments will then pay off the bondholders. If they don't make the lease payments, if they don't occupy the site, if they don't do it for 20 years, which is the commitment, then they say, we'll make you good anyway. We'll make you whole, even if we're not actually paying the leases. So all of this is not held on Meta's balance sheet. So the Journal has calculated that there are $1.2 trillion in leases, uncommenced leases, tied to these off-balance sheet obligations, and another $1.9 trillion tied to purchase obligations for chips and all the other stuff that goes into the data center. So the question is, who's holding the bag? Who owns all of that risk? If the companies themselves don't hold the risk, if the corporate bondholders don't directly hold it, and the answer is probably us.
Yeah,
at least in part. If we're in a pension fund or retirement fund, whatever, that is buying some of this credit. If financialization becomes the impetus in and of itself, in the mortgage case that you cited, what got us into trouble in the financial crisis is that you had the risk of the mortgage so far removed and sliced up and repackaged, that it masked the underlying risk for a lot of people. So is the concern here that you don't have a good sense of the underlying supply and demand, the fundamentals, because it's so far removed from the actual project?
And I think that's the fear too, is that this is such a long-term play. Half of these lease commitments haven't even gone through yet. They're all just being discussed in the background, sort of, that we don't really understand the full picture just yet. And if this is happening over the course of, say, the next 10, 20, 30 years, when does this end up on the company's balance sheet? How well we know?
Okay, and that is basically, and that is basically what we have been talking about. I think Lawrence has been shouting this at the top of his lungs in the comment section for the last couple of weeks. But really, there is a lot of off-balance sheet spending by a lot of these companies that is hard to track. Who is the one that's ultimately going to be the bag holder remains to be seen, right? And they are suggesting that it is the everyday taxpayer, it's the people with the pension funds. This is exactly the same concept. Do they get to the same level of over here? Yeah, I think they do, right? You can see over here, you have around $200 billion in lease liabilities on balance sheet, $900 billion of lease not started. So that means these are still off their balance sheet. Long-term debt, $56 billion on the balance sheet, and $1.5 trillion in debt. So I think the numbers that they were using earlier on that commentary, 1.1 billion and 1.9 billion is over here. But they actually combine both the on-balance sheet and off-balance sheet. Again, yes, it's only 900 billion instead of 1.1 trillion, but it is still not the best, right? So you can see over here, large part of this is actually by Alphabet. Love how they broke this down. And Meta also has a pretty large part. Now, the only thing I would say is that really a lot of these companies, as Kunal has pointed out, they are cash flow monsters. If they turn this off, if they turn off the CapEx spending, they can actually pay off all of this and go back to being cash flow positive within a year or so. So we might get a 2022, 2023, but where we may all look back and say that, you know what, it was ridiculous paying so much for the AI data centers. Maybe we might see that happening. How likely that is to be the case really depends on which company. I think it's a game of chicken, like who blinks first. If I stop spending first, will I lose market share that I would rather just overbuild? Because when I was talking to people working, not in the C-suite, but in the executive levels in some of these companies, the general consensus that I get that the danger for them really is not overbuilding. The danger for them is underbuilding and losing market share for the next decade. And I think that is why a lot of these purchase commitments, a lot of these leases, they might have overextended, but they don't mind overextending, because the worst case scenario is that we see a 1 or 2 year drawdown where they just have to turn around a business, and then we get a reboot of this entire system, and then we are getting 2022, 2023 all over again. And that is why one of the names that I've been looking at is actually Viper Energy. And I think if you look at the equal weight S&P, I think that's also a good form of diversification for portfolios. Because a lot of the hype, a lot of the market gains recently has purely been AI. Like anything non-AI, I mean, if you look at my public portfolio, it looks nice. I'm up 35% on the year. S&P is just up 12%. So right, we outperformed the index by 3x. But in my main portfolio, I'm holding like 60% so far. I'm down 30% on the year. Why am I down 30%? Because I'm not in AI. I am in crypto and financials in that portfolio. I've just only gotten a bit more exposure into the AI trade this year in that portfolio, because previously a lot of the AI trade exposure was in my parents' portfolio. This portfolio that I ran on my own, I did a lot of financials and crypto. So that's how I chose to diversify my family's portfolio, right? So because of that, I didn't have a lot of AI in this particular portfolio, the Webull one. And that's why you're seeing the kind of results that you're seeing today. And then compare that to the public portfolio where we have very strong AI narratives, that is doing a lot better. Short term, this is bullish neoclouds. Of course, I think as long as they can make their payments, this is bullish neoclouds. Question is, when will they stop making their payments? I think once the first shoe drops, this becomes a domino effect. On-coding concept. In my opinion, not the way the internet built it in 2000. Massive use of AI, robotics, and quantum is years out. Yeah. So the question really is, I don't think anybody questions that eventually, right, we will be in a world where robots will be, doing the bulk of the manual labor. But I don't think that happens in the next 2 to 3 years. The argument then is that if that does happen in even not the next 2 to 3 years, but in the next 5, 6, 7, 8 years, the amount of compute needed for inference so that the models can be processed by the robots to do the day-to-day task, that amount of compute needed is so massive, more massive than anything we can comprehend. So that's the bull case. And the bull case said that it will come, maybe not in 2 to 3 years, but in 5, 6, 7, 8 years, it will come. So what's the opportunity cost of being early? This step bubble is going to blow up the economy. Everyone's pensions for 1K. The math doesn't math. I agree the math doesn't math. No, and I think that's a lot of it down to portfolio allocation, right? I don't think you can just look at your portfolio and think that you are bad at stock picking, because in one portfolio, I'm up 35%. In my other portfolio, I'm down 30%, but I'm still the same person. It's just that my allocation is, I would say 10% AI in my Webull portfolio, 90% is fintechs and crypto. Whereas in my public portfolio, I don't do as much financials because I didn't want to be overexposed to SoFi. It's basically 60% AI, either hardware or software, and then just 30% financials. The only thing, to be fair, the only thing that I kind of disagree with is the NVIDIA deal with the rest of the financials. People call it another form of circular financing. I don't think there's anything circular about that. I think this is more like okay, the way I see it is like you're a kid and you go into the nearest Toys R Us, you see a toy that you want, and you really want to buy the toy. And your parents refuse to buy you the toy. And the parents in this case are the banks holding all the money, right? And the kids being the neoclouds and all the other smaller companies that's around the AI trade. And they go to Big Daddy Jensen and say, Daddy, explain, or not Daddy, I mean the store owner, the Toys R Us store owner, whoever it is, explain why we actually need this and why your child actually will benefit from this. And this is actually a true story, by the way, because when I was teaching, we got the kids to download an iPad app created by this company that was supposed to encourage a lot of like mind exercises, right? So they do things like they turn on and off. So they show you a picture, perhaps with like red dots and green dots, and they're going to flash it to you for just a couple of seconds, and they'll suddenly take the picture away. And the question will be, based on your estimation, were there more red dots and green dots? So it develops the kid's cognitive function, but to the parent, it just appears like the kid is just playing game on the iPad. So we had to get someone in to try and talk to the parents. Although there was some difficulty in arranging for that person to come down, but at least as teachers, we had to be that go-between, like telling the parents, hey, the kids are not just playing game for the sake of playing, did assign this and all that, and assure the parents. So in the very same way, it's like this group of people want to borrow money from the financial institutions. The financial institutions are like, nope, not going to lend you money. Big Daddy Jensen came down like, hey guys, it's fine, lend them the money. They're going to pay me, and then, it's is it circular? It's circular if the money comes from Jensen. Like previously, when I'm giving you money to buy your equity, you go and purchase stuff from Nvidia. I can see how that is circular financing. Although Nvidia does that get equity in the company, right? It's not just giving them money. In this case, he's more like the go in between to explain why and how does this work, why they need the money, and they're going to invest in him, and the kind of returns that if they invest in Nvidia, they being the smaller companies, they buy Nvidia's chips, the kind of returns they're going to be able to get, and how they're going to be able to service the loans. It's kind of like giving them a little bit of an assurance. So I feel like that deal, that $500 billion deal with the finance sector, that is not considered circular financing. The part about Nvidia buying equities in this company, companies using that money to buy Nvidia chips, can be argued as circular financing. Yes, I can see that. So, and the reason why I'm actually bringing that up is because this $500 billion deal, I think a lot of people, especially the bulls, think that this is a foregone conclusion. But if you read very carefully, it says that this is a memorandum of understanding as well. It's also an MOU signed with the 6 companies. There is no obligation that they have to spend the entirety of this $500 billion. So to think that the entire AI trade is going to have $500 billion to backstop the entire thing, that is a false understanding of what actually happened last week. This is just a memorandum of understanding. They are willing to lend them up to $500 billion, but it doesn't mean that every single penny of the $500 billion will get spent. So you put all the pieces together. We have higher yields, not just in the US, in Japan as well. Why is Japan important? Because we have seen what happened with the yen carry trade. A lot of traders, a lot of the quants, a lot of these financial institutions, they borrow the cheaper Japanese yen, they borrow the cheaper Japanese dollar. It becomes kind of like the global liquidity, buy US stocks. When the yields in Japan rise, the spreads kind of tighten, so they have to sell off their US stocks to basically pay back the debt. So that's number one. Secondly, we have the US 10-year and 20-year and even the 30-year at 3-decade highs. So that's going to affect the borrowing cost, right? So of course, some of the borrowings that have already been contracted, those might not be affected, but then it slows down any potential future borrowing, which means that there is a line in the sand where people are no longer willing to take on the risk of this AI buildup. So that's the second thing, right, that we have to consider. Then on top of all of that, all of these companies, they do have a bunch of off-balance sheet agreement that might be held by various either financial institutions who then package this in special purpose vehicles, sell them to the consumer. And if the consumer holds on to these bonds and eventually even if they don't fully default, even if they do not fully default, they are going to get hit. Like myself, I'm holding some fixed income. I know, I believe it's not down by much at the moment, right? It's not down by much. I believe we have around 220,000 in fixed income, 210,000, sorry, and it's currently around 197,000. So we're down around 13,000. It's like what, 5%? So 5% down. You put all of that together, you really get a recipe for volatility in the next 2 to 3 months. Plus the midterms. Seasonally, between August and October of the midterms, we see a drawdown of between 7 to 10%. That's what I read. can correct me if I'm wrong, but I believe the stat that I read was that between like is it August, maybe September to October, during the midterms, in every single year except for '06, we have seen around a 7 to 10% drawdown. And I think the drawdown plus the negativity from the yield that is going to bring the entire AI sector into another round of volatility, like in July. And at the end of the day, it tests your conviction. What do you believe? If you think this is 2000, 2008, then it's good for you to perhaps take a little bit of shelter in other sectors. You have, like for me, software could be a name or could be a sector that is worth hiding out in, which is why AppLovin is something I'm looking into, and energy as well, which is why I'm looking into Viper Energy. I have never been more grateful that I studied chemical engineering in university. So at least I kind of understand what's happening there. I'm a horrible engineer, by the way. Yeah. I always tell my friends that, and my friends know. Like, my engineering really isn't the best. Like, I was always very good at math, but it's just the physics and chemistry behind it that I could never get. So I guess the hints were already there that I would end up in finance. But everyone wants to stay at the party. Who's going to clean up when it arrives? That is true. This is basically musical chairs. Everybody, let's just admit it, all of us are degenerates. Nobody wants to be the one sitting on the sidelines and looking at the party go on, and you're not being a part of it. Yeah, at least my math came into good use. Like this I never, when like growing up, never ever thought of doing anything related to financials, because in Singapore especially, we all grew up thinking like investing is gambling. So even when I was in like middle school, secondary school in Singapore's case, my science wasn't the best. But I was always fantastic at math and logic and stuff like that. But I never ever put two and two together. My first two job applications, prison warden and teacher, and then I got into teaching because the prison service in Singapore said that I was too friendly. So since the idea of the boom is so big, it will be overcrowded and the rotation will be just as big. Yeah, I agree. I think like Tom Lee is saying, whether or not we get a 20% drawdown, I think it's a little bit hard for me to conceive what will happen that will cause a 20% drawdown. But I think we can see a very slow bleed to maybe a 10%, 12% correction, like what we saw previously. I think that is going to really hurt. Right? A lot of people are really going to get hurt, because I think after that July dip, people have gotten in, and I'm facing this at the moment. There are people that I know who have gotten in at pretty decent prices. They're up 20-30% on the year. That July dip really scare the crap out of them, and they're one out of the markets right now. So you're going to see people, especially funds, try to lock in gains for the year. So it's going to be a push and pull, right? You also have, on one hand, you know that after the midterms, markets tend to do well. But yeah, today is a painful day. It's a red day in the market. Anything high beta is definitely down, and it makes sense, right? Even Google, although it is green on the day, we are still at 340. And like I said, now Google, the 50-day moving average has crossed under the 200-day moving average. So kind of like the death cross. And I believe that we will continue to go a bit lower. There is some volume shelf at 315. That might be a good place to start DCAing into Google once again. Meta at 5. All right, let's take a look at what's happening in the markets right now before we go back in. Okay, before I talk about Viper Energy and before I take a look at UiPath, I'll be honest, my research on these two companies, not fully done. I was spending too much time trying to set up certain things in the background, trying to come up with all these all some of the background stuff for future streams and trying to plan out the structure of the streams. Did not really get as much research done as I would have liked. So I'll just do it on stream later on, right? That's why we come on stream earlier. Let's see. The SPY is still, I mean, S&P is still down 0.5%. I think this is perfectly fine. We have been, I think this is a well-deserved breather for both the SPY and for the Qs. The SPY, at least it made an all-time high. The Qs didn't, right? Ever since the July correction. So this July correction was actually, how deep was this? Let me draw this out. If you take 74, 747, this was around a 12% drop back in July. Do I see another 12% drop? I really wouldn't be surprised. I really wouldn't be surprised. Yeah. If we get back to 670 or so, I really wouldn't be surprised at all. Okay, the VIX is, I mean, the VIX is up today. It's fine. Singapore stocks down. Okay, so the reason why Bitmine is up, I mean, see, again, Bitmine is above 1 times MNAV, is because Ethereum is flat, basically up 0.6 basis points, right? Up 0.06. Bitcoin, I think Bitcoin seems to be having a problem getting past 65,000. I think we really need Bitcoin to get past 65,000. The good thing is that we have seen Bitcoin bounce twice off here. Now, one of the, I don't know whether you can say a bullish thing, but back in January, if you remember Sean Farrell, where is he? Sean Farrell, where is Sean Farrell? Oh my goodness. I think I need to have a better format. Is this a little bit of a lower high? Possibly. Yeah, it could be a lower high. I feel like if it cannot break past 65, 66, we might see another retest of the 50s. So I think the real battleground is above here in the 65, 66 zone for Bitcoin. But our dear Clarity Act, the vote is in September, Riaz. So I think up to now, I think they're working in the background to really get the 7 Democrats on board. I think if the vote had gone through on 30th of August, 8th of August, sorry, they would not have gotten the Clarity Act passed. They did not have the required votes. Now that it has been extended to September, could they get some Democrats on board to get it passed? Perhaps. But I personally don't think that it is likely that they will do so. Yep, SEC was ready to move, but politicians stopped them. I mean, anything that you give the government to do is usually going to be inefficient, right? So, I mean, yeah, I guess to a certain extent, I guess you can say it's a price to pay for democracy, but sometimes the government just gets in the way, most of the time. Yeah, you see, one thing that people are underestimating is the draw of the crypto crowd. So if the Democrats want the votes from the crypto folks, I think they want to get it passed, but they want to be the ones to be seen as, hey guys, we are the ones that got the Clarity Act passed. They do not want to give Trump the win. Then the question is, what's going to happen in this gap of 2 years, let's say between 26 to 28? And if we get another Republican administration, are they not going to let it pass under the next administration, or do they just not want to get it passed under Trump? Because the longer it is that they do not get it passed, even Brian Armstrong said so itself, some of their operations would then have to be moved offshore. Right? So we don't want, I mean, as someone who has vested interest in America doing well, I do not want to see that happening. You see, the thing is, Trump already got rich on crypto. So the irritating thing that I found was that he got rich on crypto before, like right at the announcement of his presidency, he launched his Trump coin. I am totally against that. I think that's 100% scummy move. But what are you going to do? Unless you want to retrospectively go back and like seize that money from him and sue him for that, that is a completely different thing. But I think even then, that shouldn't be the sticking point for the Clarity Act, because the regulation is already in place for the administration, the governments, not to be able to buy it. So I do understand, not to be able to abuse the system. I do understand that they want certain judges to be able to enforce it. That's number one. Second thing is that I believe the current wording don't cover children, right? Yeah, so I think because of that, we might see a little bit of a pause. So I don't expect, in fact, personally, I think I've said this for a while. I don't expect the Clarity Act to really, I don't expect the Clarity Act to really cause a boom for crypto. I think the crypto winter ends when the crypto winter ends. This is a normal 4-year crypto cycle. We are going to see it come back into play again, late 27, early 28. Until then, I will just be selling very aggressive covered calls and cash account puts on the position, squeezing it until it turns profitable. I believe right now, my average cost on this position, I've lowered it from $36 to around $28, $29, just because I've been receiving the premiums all along. So I think over time, you just need a strategy to be able to hold on. Because I don't think this is something, BMNR is not something that is going to like pump by the end of the year. I don't think so. Could it pump in 2027? Maybe. But as I've explained yesterday, it's a little bit like AI tokens. You want it to be so cheap. You want Ethereum to be so cheap that ultimately what drives the value is the throughput and not the cost of running the ecosystem, which means the gas fees are not going to be that high, especially when transaction is low. But they are trying to make it so low that transactions will automatically come on board. They can support the amount of transactions that come on board. And naturally, when these transactions come on board, with the mechanics of how the base fees for Ethereum is being structured right now, it increases in an exponential manner. The one thing that is really keeping the entire AI trade going actually is this piece of news over here. Anthropic's revenue run rate hits $65 billion ahead of RPO. So Anthropic's annualized revenue run rate topped $65 billion as of late July, representing more than a 7-fold jump since the close of 2025. So means they were $9 billion at the start of the year, right? Close of the year, so I'm presuming like 31st December 2025. 1st January, they were at around 9 billion run rate, means expected throughout the year. So basically, they are saying they are making just over $5 billion a month right now. I think this is more or less the kind of numbers that have been reported. Some people say 65 billion, some people saying 70 billion. They're in that ballpark, and I think they're expecting to do around $100 billion of revenue this year. So is Anthropic free cash flow positive? Yeah, they are, right? So the only thing about the AI trade is this, is that Anthropic in second quarter, is it second quarter? I feel like I saw it somewhere. Give me a minute. I can't remember what was the article that I read, but on X, you actually see that on Dylan Patel's latest podcast, Anthropic turned free cash flow positive in the second quarter of this year and entered profitability both in April and May. Profitable, cash flow positive. At the time of recording, June has not been closed yet. So in June, their annual ARR has been around 50 billion. So in the last 1 month, they have increased to 65 billion. I can confirm that I am one of the people who has caused them to increase because of how much I use Claude. I've just increased my subscription beyond max to like the $300 per month one. And I'm at 75% usage, which is crazy. But it has done a lot in terms of helping me run certain things in my business, run certain analysis on companies. But I think teaching it takes a lot of tokens. It is very token intensive to really train Claude to do what you want it to do, because otherwise it still sounds like an AI. But okay, so what I'm trying to say over here, earlier on we just said high yields going to make lending harder, and we have already seen there's a huge $3 trillion of off-balance sheet debt that has to be financed. We are worried that the consumer ends up holding the bag. If that is the case, the US economy goes into a recession. And I think when you go into a recession, largely everybody suffers, and it's only the biggest companies that can get through. And that is why maybe some of these companies like CoreWeave, with a lot of debt on their balance sheet, those will get hit the hardest. Whereas the cash flow heavy companies, your Googles, your Amazons of the world, they may get hit for a year or two, but eventually they will return. Now, my argument is that I think in the neo cloud space, we still, at the end of the day, recession or not, we still do not have enough compute, and we do need to have the neo clouds around. I think they are a viable business model. They are just not as lucrative or as big as people think that they're going to be. So I think it is a winner take most space. So likely we're going to see Nebius, CoreWeave take the lead, and a lot of these other smaller neo clouds actually consolidating eventually, right? But with that being said, the argument over here is that all of this is only a problem if there is no payoff. But Anthropic is showing, hey, free cash flow positive, profitable. Now, are they just doing this because they are gearing up for an IPO? Maybe. I think we really need to wait for their S1s to be released before we get a better idea. Oh yeah, agreed. I think it's not just Washington. I think it's same for most governments. Yeah, and the specs did not work out, right? The specs really just did not work out. Cloud models are way better than OpenAI. No, I have a friend who does this very circular thing. So he like uses ChatGPT, the base. Okay, he doesn't use the free subscription. I think he uses the cheapest subscription. Uses that, creates the prompt, puts the prompt into Claude, asks Claude to generate whatever agent flow that he's trying to work on, and then feed that back into GPT to ask GPT to correct it, and then the two AIs are basically talking to each other. Thanks, Lawrence. Yeah, I think it's important because like for me, I mean, full disclosure, I manage like my full family's portfolio, right? I'm only showing you my part of the portfolio, but I have my parents' portfolio and all that. And so I can't be like perma bull AI all the way. because yeah, I mean, I do pay them. I do pay my parents actually on a monthly basis from the options that I'm selling. So that funds part of their retirement. The good thing is that I've gotten them backstopped all the way until, yeah, I've got basically, those funds that like to give people a 5-6% return. I'm basically giving my parents around a 5 to 6% return, and I've already gotten funds backstop all the way until the end of 2027. So even if my covered calls, every single trade fail from now until 2027, and I'm just rolling and rolling and rolling and rolling all the way for the next 18 months, my parents will still have enough to live off around 5 to 6% yield. And the best part is they do not have to pay any fees to all the different fund houses. But yes, because of that, I'm always going to be a little bit more on the cautious side of things. Like if it's my own portfolio, and if I'm, working a 9 to 5, sure, why not? But for me, yeah, my situation is that I'm making most of my money from the portfolio itself. My 9 to 5, it's not really a 9 to 5. It's more my 9 to 5 has become kind of like my side hustle. Yeah, and so this is basically the main thing I do, and because of that, I have to be a little bit more prudent. I'm not making thousands from YouTube like the yeah, like the bigger channels. I never get GPT to fix slot. It's the other way around for me. Yeah, I really got what my friend is up to. He's really been experimenting with it. Like I introduced him to Claude and Cowork and coding, and then yeah. Okay. Right now, I just want to very quickly jump into my BMNR spreadsheet, and then after that, we'll take a look at UiPath and Viper Energy, because I just want to check whether or not they are over a 1 times MNAV today. No, the thing is, I believe that there was some news that came out yesterday about Tom Lee. Oh, see, I get so distracted. I forgot I was supposed to show you this Sean Farrell article, but first, okay, let's jump to this. No, this is the portfolio. What am I talking about? Where's my BitMine? It's here. Okay, so again, we are back at 1.01 times MNAV because we are trading at $18.74. And with everything as we calculated yesterday, the net asset value per share is $18.64. So just a very quick disclaimer. I think some people have asked me in the comment before. My net asset value per share, I actually do not count it including the amounts over here of Bitcoin and the moonshots. If I want to add this over here, you could say that the net asset value per share might be a little bit higher, closer to 1870, and then we are just at 1 times MNAV and not 1.01 times MNAV. Fair. That is a perfectly fair argument. What I would say is that gives you a little bit of on the upside. What do I mean? For example, the value of Beast Industries of 8Co could actually spike, or the value of Bitcoin could spike, and then you will see an increase in net asset value per share, but it's not due to their main business, which is Ethereum and staking. Right? So you can have artificial rises in net asset value from the moonshots and from their Bitcoin holdings, which I want to completely erase out of the picture. So that's why I only pay attention to ETH and the cash positions. And right now, and I think at the start, when I was doing this, it made a little bit of sense to include moonshots and Bitcoin because it made a relatively big deal to this. But right now, if you take a look over here, we're talking about $10 billion. This is just a $200 million position. It's not that big a deal. Even if I put this at $11 billion, you're at 1889. So it really doesn't make that big a deal right now. And I'd rather to be more conservative and not have that extra upside potential, right? So if Bitcoin runs, or if their investments actually do well, and I do not want to see that affecting the net asset value per share because it's not tied to their core business, which is owning Ethereum and staking Ethereum. So with that, okay, we are at 1868. So MNAV has fallen to 1 times. Now, like I said, there were periods of time today, obviously, in the last maybe 1 hour or so, as well as a large part of yesterday, that Bitmain was actually trading above a 1 times MNAV. I think they only left $78 million on their balance sheet. So they definitely do need to have a little bit of opportunities to raise capital, and I think that they would have an opportunity today. Yes, I think in general it is good for me to see that there is relative strength in crypto compared to the rest of the markets. I think with the 10-year at 4.7, 30-year at 5.3, it's only natural that we are seeing a little bit of pressure in the equities market. The last thing I want to talk about before we jump into looking at Viper Energy as well as UiPath is this article by Sean Farrell. Let me see. Okay. All right, so this is actually by Sean Farrell. Bitcoin may be due for a 30% swing in either direction, according to Fundstrat Global Advisors. Sean Farrell, the firm's head of digital assets treasury, he was the one that called Ethereum 1800, right? And he has proven to be right. So let's listen to what he has to say. Farrell's Monday note found Bitcoin 30-day price swings rank among the smallest on record. That pattern has often preceded much larger moves in past cycle, which means in the last 30 days, that spread of how much Bitcoin actually moved has been one of the smallest on the record. So that spread is not a lot, right? The price movement's not been very volatile. And this pattern over 30 days, if Bitcoin doesn't move by a lot, it tends to precede a much larger move according to past cycles. So in 8 episodes of low volatility, Fundstrat found that the median absolute price move over the following 60 days was around 30.2%. 4 of those 8 instances ended in gains. 4 of the 8 instances ended in losses. So we were just talking about this earlier, right? If Bitcoin doesn't hold above 65%, we are likely going to retest the 50,000 range. And for those who are like long-term bullish crypto, might be a good time to add. I know I am like being greedy on my cash account puts, but they did not assign yesterday when I tried to close them. So it's not my fault. I did try to close them. I did not forget. I just forgot to check whether or not they got assigned. So I'm still stuck holding it today. But like I said, right, there is a chance that crypto goes down. I don't think that is completely out of the picture. You saw the chart earlier, right? Bitcoin is having a problem getting past 65,000. If it fails to get past 65,000, Sean Farrell is telling you 4 out of 8 times, basically a coin flip, that it will go up, and another coin flip, it might go down. So that is crypto for you. Basically telling us that it will move 30%. But this is such a clickbaity title. I think I'm going to use this in my next BMNR video. 30% move. 30%, and 4 out of 8 times it went up. 4 out, oh my goodness. It's basically he said, I don't know. I think it's going to move, but I don't know up or down. I just know it's going to move. That is basically the summary of everything he said. Okay. 30% swing from 64,000 would put Bitcoin at 83,000 on the upside, 44,800 on the downside. So that's exactly what we're saying, right? We're talking about the low 50,000. So because that's where the chart hits, if we cannot break past that. So I think we get a little bit more of that low volatility. We will come into contact with the 100-day moving average, and that will be the deciding factor. If we break past that, 83,000, here we come. If we do not, then 44,000, here we come. Which is why, although I'm selling cash account put on Bitmain, I am not too keen on getting a sign right now. I hope I get to close this one first. Okay, you know what? I have to do that later on. Bitcoin rallied 2% on Monday, lagging other cryptocurrencies. The asset lost nearly 27%, attributed a meaningful part of the bounce to traders closing bearish positions rather than fresh buying. That's perfectly fine. If traders are closing bearish positions, I think people usually think it's a good thing. But again, that they're closing bearish positions doesn't mean they are not reopening them again. They might be just rolling those positions out. Yep. So again, he compared the move to the short covering rallies in early June and early July. Those rallies initially pushed prices higher before fading, a pattern that B in crypto has flagged before as a bear rally in disguise. So his base case expects something similar this time. Yep. Farrell flag again in rising real yields, the return of bonds after inflation. Yes, Bitcoin's biggest risk. If yields keep climbing, it ends Bitcoin unusually calm trading range. Okay, so he's basically saying 50% chance we go 30% higher, 50% chance we go 30% lower, but based on the rising yields, chances are we are going lower. Base case, we see the move that pump up that 2% on Monday kind of get faded off. Okay. Yeah, I think that is more or less the kind of consensus that we have on this channel over here. I think crypto winter still on. Clarity Act not going to change. In fact, if anything, might even be a sell the news event. Yeah. So let's see how it turns out. Yeah, I mean, one of the things that I do have 50,000 spare cash, maybe 50,000. Okay, I'll be very honest. I'm probably taking $10,000 out to invest in Pokemon. I can't sell options on Pokemon. I'm very well aware of that, but I just want to, yeah. So maybe I got $50,000 left, right? But I'm trying to decide where to put that $50,000. I'm a bit adverse to buying more SoFi. I'm already heavily concentrated in SoFi. This main portfolio is like 60% SoFi. The other portfolio is 30% SoFi. Put it together, my average portfolio is like what, 40-odd% SoFi. And going into, I mean, I don't think we are hiking rates. But going into this cycle, I think, yeah, where we still have uncertainty on interest rates, holding SoFi might not be the best idea. Okay, I just want to, one last thing before we get into this. Mid-40s Bitcoin seems like a good deal. Yes, I think I would definitely be buying Bitcoin. Yes, I'll probably be buying Bitcoin there. And I might even dip my toes into MSTR, something I've never done before. But I've been preparing for a potential on that. Where is... Okay, where is it? Where is Liz Thomas? I believe I saw Liz Thomas. Okay, this is just a 2-minute short clip, 3 minutes, sorry, short clip of what Liz Thomas has to say about expectations, and then we will end with this. Not end with this, we will transit into the next segment after this.
This week's inflation data with Liz Thomas, head of investment strategy at SoFi. Good morning to you.
Good morning.
We were just chatting during the commercial break. I said, how's the world? You said, do you want to say what you said?
I said, the world is falling apart, but the market will rise.
Okay, so explain that.
So we've got an era of warm inflation. I'll call it warm, not...
Do you hear what she says? The world is falling apart, but the markets will rise. What a good summary.
hot. We had some promising data last week. But warm is uncomfortable for many market participants and uncomfortable for the globe because we haven't been in an era like this in a long time. Bond yields are attractive if you want yield, but not attractive if you don't want volatility and if you don't necessarily trust central bank action right now. And then obviously the geopolitical headlines that I don't need to tell anybody about that don't seem
right,
to
so
be
you have
going
all
away.
of that, and then you said that, but the markets are going to go up. So
all of that.
This is what I think is has a lot of our viewers saying, well, what are we
So she's basically reiterating everything we have said on today's show: high yields, conflict in the Middle East, plus whatever crypto that we just said, which she didn't touch upon. Volatility in the world, but markets will go up. And like what Lawrence was saying, the problem with LLMs for most people is that there's no reason to pay for them. Yes, okay, he's using Gemini for free. To a certain extent, I agree. In my previous company that I was working in, I was just having lunch with my previous director, and he's still using the free version of GPT. Right, so it really depends. Like, people haven't gone into that. So it really depends how you spin it. If you are bearish, you would say that, hey, people are just using the free one. My sentiment tends to be leaning on slightly, I would say 51-49. I would say that people are using the free one because they don't understand how good the paid one is yet, because they're still treating it like a search engine. If you are treating it like Sonnet, right, even Opus 4.8 can do as well as a normal Google search, or even better. There's no need for you to start to use Fable 5. But once you start to get into the hang of what AI can actually do for you, I can tell you, majority of my friends, they are brilliant engineers, but I don't think any one of them really uses AI. In fact, a lot of them are a little bit scared of AI. Previously, when AI was just this glorified search engine, everybody was very excited about it. But right now, when you start to think about AI replacing people doing the jobs that they're doing, I think people are getting a little bit skeptical, a little bit afraid. I'll be very honest, at the start of this year, I was just discussing about the possibility of hiring somebody to do some of the back-end admin stuff, like the day-to-day putting together of the news articles. So if I dump a bunch of links into Apple Notes or Google Sheets, someone can actually come up and help me write out the point forms, summarize the articles, so that I have something to talk about on stream. But right now, I just dump everything into Notion or dump everything into Apple Notes, and straight away, Cowork can refer to that note and write up the summary for me. And so instead of paying someone about $1,000, $1,500, $1,500 a month, I'm just paying $100 to $300 for all my GPT and Fable subscriptions. Let's carry on with this, and then we'll talk a little bit more about inflation, about how that affects the bond yields, and then how that affects how they're looking at how SOFA is actually looking at the markets for the rest of the year.
Supposed to do in all of this,
right? So I already went over the warmer inflation era, the higher bond yields. The portfolios of yesteryear are not working. They're not going to work. So you add something like commodities in, and you've got to hedge against some of that geopolitical risk that's affecting energy. You hope that the Fed doesn't raise rates. I'm on the side that I don't think they will in September. I don't think they will in October. I think the earliest possibility is December.
Because you have one, in your calculus, there's one rate hike.
Yes, but I don't like it. I hope that they don't.
Okay. And I only ask because we've had, we had Bank of America, Brian Moynihan was on. Bank of America thinks there's going to be 3 rate hikes before the end of the year.
I would disagree with that. And I think it would look like a mistake if that were the case right now, because first of all, hiking rates doesn't add people to the labor force. And a lot of the inflation issue that we're having right now is a supply issue. Yes, we have very strong AI demand, but we also don't have enough supply to fulfill that demand. Hiking rates doesn't create more semiconductors. Mm-hmm. And we've got a supply issue in energy that we're all very aware of. Hiking rates does not create more oil through the Strait of Hormuz, right? So I think hiking rates at this point, although the economy is strong, it's stable, it's not overheating, in my opinion. GDP growth is not overheating. The labor market is not overheating. Consumer spending is not overheating. We have warm inflation that, again, is uncomfortable. But I think if we start to hike and create a hiking cycle, it kills other things in the economy that we don't want to hurt at this point.
Jim Bullard's point was it's a lot harder to control inflation when you have a bad economy. His thought was if he was still on the FOMC, he would raise rates now. I don't know about how many times. I don't know if it's 3 times, but to try and bring inflation down now, when you can do it without it being such a painful decision because the economy's in need of help as well.
Yeah, and look, I respect Bullard. The Fed doesn't call me for my opinion, right? They're more likely to call him. But I think right now, yes, the economy could probably absorb 1 or 2 rate hikes. It's not about 25 basis points or 50 basis points. It's that if they start now, the expectation is that they will keep going until inflation reaches target, because Chairman Warsh has been so committed to that 2% target. So let's say they raise in September. I think markets will expect that they'll keep going until they get to their goal. And that's what I would be concerned with, because getting to that 2% goal has proven to be really, really difficult already for the past several years. I think we would have to hurt quite a few things in the economy to actually get there. So I would prefer we stay at this point, stay at this level, wait and see if things come down on their own while the economy remains strong.
All right. So all I've gotten from that is Bank of America is trying to be like Citadel. They are trying probably to flush out some other big investor so that they can swoop in and buy all of their assets for 40 cents on the dollar. That's the only thing that I've gotten from that so far. I think to expect 3 rate hikes this year is a little bit extreme. I really do not think we will get 3 rate hikes. So just broadly to cover what she says that we are expecting the US in general to basically be in a warm kind of inflationary environment. It's no longer the deflationary, no inflation kind of time in the 20-teens. We are in 2020s, mid 2020s. I think now to the end of the decade, we might be expecting warmer inflation. That could mean around 2.5% to 3.5%. Honestly, to be very frank, something that cost $1.20 to $1, I think for something that costs $1 to next year, perhaps cost $1.03, it's really not going to hurt people that much. I think 2 to 3% inflation is something that we can deal with. CPI was 3.4%. PPI was also down. So I think it's going to be a volatile inflationary period, but like she said, it's going to be a little bit more warm, and we're just going to have to deal with it because, number one, rate hikes does not solve the supply issue. Right now, the problem is semiconductors, we are short of supply. Energy, we are short of supply, which is why later on, I'll talk about a little bit about Viper Energy, what I understand about them. I've just started looking to them a couple of days ago. Right, I am looking into the energy play. Now, I would say that the risk for the energy play is that if we do get into a recession, usually people have been telling me historically, the reason why I've been looking into energy is that if we do get into a recession, historically, it's due to inflation, due to high oil prices. And it's kind of like a hedge against the Middle East without like that just outrightly buying a short on your portfolio. The reason for that is because if I buy a short or buy a put, on the portfolio, even if I might allocate 1 to 2% to buying puts on the Qs, right? But I think in general, if you expect this to be a little bit more long tail, the energy sector does give you a little bit of a hedge, which means you don't expect it to do well if the war does well. But at the same time, it's not like a put where it can go to zero. It's definitely not going to go to zero. However, if the war persists, oil prices go up, then you'll start to see these energy companies actually go up in price. And like I said yesterday, energy is 3% of the S&P right now. I believe historically they used to be around 7 to 15%. So there is place for the broader markets to actually expand, right? So even if the broader rally expands, I expect energy to catch a little bit of a break as well. So that's the first thing. Second thing she said, Bank of America, and I believe Bullard was expecting more rate hikes. Bullard is actually saying if he's on the Fed, he's going to hike. How many hikes? He did not indicate, but he said he's going to hike. And secondly, Bank of America said 3 hikes. Like I said, I think Bank of America is trying to crash the market so that they can buy out some other hedge fund. That's the only reason I would say they expect 3 hikes. Like Citadel has tried it once. I don't think it's going to happen a second time. Okay, I don't think, I don't know. I think Bank of America is just trying too hard right now. 3 hikes is very hard for me to see 3 hikes. Even 2 hikes, for me, it is pretty unlikely. I am firmly in her camp. 1 hike at most, and I would already be unhappy with 1 hike. Again, that then takes me into a side note on SoFi, which is Anthony Noto on the call saying, look, we are baking in 2 rate hikes, telling you 60 cents EPS. But if we get lesser than 2 rate hikes, then yes, there is going to be upside to our bottom line. So if you combine that with what Liz Young was saying on CNBC, where she's expecting 1 hike, right? So they're telling you, I expect 2 hikes, But internally, they're expecting 1, which means there is definitely upside to that 60 cents EPS. SoFi below 18. Well, okay. Hopefully, it's 2 cents below 18 for now. Hopefully, it goes back up after that. One other thing she said, supply. See, I said, Lawrence, you distracted me with this. I saw Pokemon cards and I got distracted. My goodness. I wanted to say something else. I can't remember what I wanted to say. Li Xiang, what did she say? Does it solve the supply problem? One card. I can't remember. She said something else which I wanted to comment about, but I got distracted by this. No, so you see, my problem with Pokemon cards is that it's such an expensive hobby, and I've been putting money into Pokemon cards for like since 2022, 3, around there. So I have done well, but the thing is, I don't want a lot of my collection. Like I like to collect the cards, so I need to have a portion of the hobby that I'm actually buying cards that I kind of like, but I don't mind selling so that I can generate some cash flow for myself. So that the hobby is not just a cash dump for me. Right now, it's mostly a cash dump. I mean, I think I can show this. In Singapore, we actually have like an eBay kind of platform. Let me see. No information is showing, right? I think there's no sensitive information. You can see over here. I'm not sure if you can see. I don't know how do people do this. Oh. So you can basically see over here. This is an app known as Carousell in Singapore. In the past year, basically done around 15,000. Oh, it's not in the past year. This is like in the last 1.5 years, 18 months that I've been selling this. We did about 15,000, 16,000 in revenue, not profit. So it's been a pretty good, like decent, side income kind of thing coming in, but still it's not enough to cover how much I spend. So I'm hoping that, maybe I have a portion of the portfolio that I'm intentionally flipping and a portion of the portfolio where I'm really holding it because I like cards. But yes, got distracted by that. Can't remember what Li Xiang has to say. But with that, let's dive a little bit into Viper Energy before. Okay, so Viper Energy, it's basically they own the land and they own a lot of the oil and natural gas properties in North America. I believe they own over 90,000 acres. Let me see if that's right. Okay. So what they do over here, I do have that 10K. Did I pull up the 10K over here? This is the 10Q. Where's the 10K? Annual reports. Annual reports. Give me a minute. Uh, 10K annual filings. Let's see. Let's change this filter. 10K. Right. Give me a minute. Okay, so this is something that I think not many people do online. I used to like to watch. There's this pair of guys. I can't remember what's their name. I think they work for the Motley Fool or something like that. But during the pandemic, they used to do like these company breakdowns where they actually take you through understanding the fundamentals of the company. It's not a very deep dive per se. It's just about an hour, long enough that it's more value than what you usually get on YouTube, but not to the extent where you can actually make an investing decision. But what I'm trying to do is that over time to kind of emulate that, to put a bit more fundamental analysis out on YouTube. I know it's usually not the best performing kind of content, but I think it's important, especially if you are staying with the stream all the way for the last 2 hours. I think it's important that we start to dive a little bit into this so that we can understand what we are buying. The economy will be in a depression. I know. See, okay, I suddenly remember what I wanted to say. No, so James Bullard was saying that we are not going to hike rates. Like, it's better to hike rates now because the economy can actually take it, rather than do it when the economy is weak. But the flaw in that logic, at least to me, is that when the economy is weak, there's probably no need to hike rates because that will naturally bring down inflation. But by hiking rates, you might accelerate the economy weakening. So it's a little bit of a chicken and egg. If you don't hike rates, you might cause inflation to spiral. And the AI boom that will increase efficiency and lower down inflation is not yet coming. So that could be a problem. But yet at the same time, if you hike rates, you cause the recession. I don't think Kevin Walsh wants that. And so Kevin Walsh, if you have listened to his last two press conference, he sounds like someone who is trying everything in his power to just not do anything right now. I don't get Pokemon cards. It's okay. Now, I've been playing them since 1996. So I started playing them, not 1996, 1998, 1999. So I started playing them when I moved to Australia. So I moved to Australia when I was around 8 going to 9, at the end of 1998, I think. So 1999, end of 98, early part of 1999, that's when I got introduced to Pokemon cards. Got hooked, came back to Singapore, got too expensive. School was too hard in Singapore. You can't play that many games. And then eventually the interest died when it came back. Do you actually think you would enjoy Pokemon if some cards didn't appreciate? Yes. I play the game, so like, I keep some cards that don't appreciate. I can't believe people are paying what they are paying for. Yes, of course. I think this is like, I treat Pokemon card like I treated crypto in the past. It's just like 2% of the portfolio, max. If someone wants to pay you dollars for a cartoon on a piece of cardboard, sell it. Yeah. So I think this one for collectibles, yeah, it's an interesting market. Like I said, like in Singapore, I can tell you, Pokemon cards are a lot more popular than sports cards. But I know in America, like the baseball cards, those are the crazy ones. So I think different demographic. All right. Okay. So the reason why, largely thesis over Viper Energy is very simple. They are very capex light, so they actually just charge royalties, on the land that they own. And so basically, when someone drills on their land, they basically skim off a little bit on the top. So let's see. We are publicly traded Delaware corporation focused on owning and acquiring minerals and royalty interests in oil and natural gas properties, primarily in the Permian Basin. So I realized Permian Basin. See, I actually went to Google this Permian Basin, large part of Texas near New Mexico, right? Am I mistaken? Yeah, near New Mexico. So effective November 23, we converted our legal status into a Delaware corporation. Our primary business objective is to provide an attractive returns to our stockholders by focusing on business results, generating robust free cash flow, reducing debt, and protecting our balance sheet while maintaining what we believe is a best-in-class cost structure. They are a very small company. I believe they only have a couple of employees. Our assets consist of mineral and royalty interests in oil and natural gas properties, primarily in the Permian Basin in West Texas, substantially all of which are leased to working interest owners who bear the cost of operation and developments. So they own the land, they lease it out, people drill and work on their land, and then they just pay them a royalty. So it's high margin business. It is a very high margin business. TPL, is that Texas Pacific? Yeah, I think they differ slightly. They differ slightly in terms they are both a very strong pure play oil and gas royalty structure in the Permian Basin. But I think they differ slightly in the kind of assets that they hold. Let me take a look. I was looking at this recently. Where did I see this? I have it somewhere in my Okay, so the reason why Texas Pacific Land okay, so what they do, let me see, where Texas Pacific Land, basically one of the main differences is that instead of dividends, they do buybacks. So Viper Energy, you get a 5.47% variable base plus a variable payout model. Texas Pacific Land, you get a 0.6%, and they prefer share buybacks. Zero debt, entirely focused on funded by organic free cash flow. So that is Texas Pacific. With Viper Energy, there is modest leverage. So I haven't dug too much into the debt structure. That's something I have to do. But I think for Viper Energy, they are really focused on Diamondback Energy's like the efficiency of their entire drilling pipeline. What is TPL trading at right now? Let me take a look. TPL. Since you raised it up, it's a good comparison to do. Maybe I'll do a. TPL is trading at 385, market cap $24 billion, 45 times PE. Forward, okay. I think both are pretty decent. I mean, I'll take a look at Texas Pacific. Do you really compare the difference? I think for me, it was the Diamondback Energy, the efficiency that really caught my attention. But I'll look into that because okay, Viper Energy is pure play minerals and royalty interests on, I think, oil royalties, whereas Texas Pacific, they have broader scopes, right? They do mineral, oil royalties, water management. Okay, yeah, that's something I would definitely have to look into. Why didn't I consider Texas Pacific Land? There might have been something. I'll have to take a look. I've gotten a. I will find it. It's somewhere in my research, but I will find it. We'll get into that later on. Okay. One thing I like is that on February 2026, they divested all of their non-Permian assets, including those from Cito Royalties to an affiliate. So they have consolidated or concentrated a lot of their assets into the Permian Basin, and I think that is something that we want to see. The leverage that they hold, I believe the debt structure is pretty healthy. Give me a minute. I can't confirm this immediately, but I'm pretty sure the debt structure is pretty healthy. Because okay, this happened towards the end of the conversation, but when I was talking to one of the fund managers from Capital Group, they told me they like the debt structure. That's all. I do not know more beyond that. I will have to take a look at it myself. Okay, let's take a look at the properties. Our assets consisted of mineral interests, approximately 4 million gross royalty acres and 96,000 acres of net royalty acres, primarily in the Permian Basin. Diamondback was the operator of 35% of our net royalty acreage. As of 31st December 2025, there were 43,000 gross productive wells, and this acreage, 6,500 were operated by Diamondback. Net production during fourth quarter was approximately, this is the 10K, right? So I'm not going to dive too much into it because later we'll take a look at the quarterly numbers to see what's the updated numbers over here. Our relationship with Diamondback. TPL own land, Viper Energy doesn't, it seems. Do they not? Because if they don't own land, 96,000 in net royalty acres. Let me see. Oh, they just own the properties. They don't own the land? Okay. Okay. That's interesting. Or is the Diamondback as of 31st December, Diamondback beneficially owned 155,000 Class B common stock, 47,000. Yeah. Okay, business strategy. Capitalize on the development of the properties underlying our mineral interests to grow our cash flow. We expect production from our mineral interests will increase as Diamondback and our other operators continue to develop our acreage by drilling and completing wells. We expect to capitalize on this development, which requires no capital expenditure funding from us, and believe the anticipated increase in our aggregate. Okay, let me compare this with, let's see, TPL. No, and you know what? Actually, if TPL is a good, on a forward PE basis, Viper Energy is actually cheaper. But basically, I'm okay. The way that I'm looking at this, also, this is not the only factor. One of the things about TPL that suddenly caught my attention is I just realized that they, like, when I was doing my research, I had both of them as a dividend paying company. So I always thought that, you know what, I'm going to be charged that 30% withholding tax in the US. But if they're only paying out 0.6% and they are accruing value mostly through share buybacks, that might be better for me. But right now, yeah, I mean, the margins on this in this area is sick. Look at that. Gross profit margin, 93% to 100% gross margin. What the heck? I have never seen 100% gross margin. I believe it's like 99%. It can't be 100%, can it? Let me take a look at the thank you. Let's take a look. Oil income, 586 million. Natural gas liquids income, royalty income, total 658 million. Okay. Lease bonus income related party, or total operating income. cost and expenses, depreciation, total cost and expenses 280, income from operations 428 million, net income before taxes 403, and total net income 330. So they 4x their net income in the last couple of years. In the last year, sorry, last couple of years. Current assets, royalty income receivable, cash and equivalent 77 million. Okay. Property net deferred income taxes, accrued liabilities. I used to own TPL but sold just before it went up. Lol. Yeah. No, the good thing about for me as a valuation wise, it seems that if you price in growth, Viper Energy seems to be the one that is priced for higher growth into the future, trading at 18 times future growth. Whereas TPL is trading. Let me put TPL on my watch list. The reason why I never really looked at TPL is because of their growth numbers. They were not as strong as Viper Energy. So I was looking up into the next 12 months. Forward growth is around 45 times for Viper. For Viper, for TPL. For Viper, that is for 18 times. So a lot better. But of course, with Viper Energy, I have the downside of having extra 30%. And I have the downside of having that 30% withholding tax, right? At least for me, it's a downside. I know maybe to you guys it's normal. So if I could, I might even let's see. Yeah, I don't know. I need to think about this a little bit. So I need to do the calculations to see whether or not it's worth in the first place. I don't think so. Usually growth tends to do fairly well for me. Like, I don't mind paying the withholding taxes if it's growing faster. Like, I can't just decide everything based on the taxes, the 30% tax. But I will put TPL and then I'll compare both. Okay, let's see. Current liabilities, they have not much current liabilities. Accrued liabilities, total liabilities, long-term debt, $1.6 billion. Okay. So let's see. If I jump here, their interest expense is not that high. It's just $24 million. It's not too bad. Interest expense 24 million. Yeah. Okay. Yeah. I will come up with a full thesis on this, but basically for me, I like the capex light model. Number one, I like that they're in the energy sector. Number two, a bit concerned about the dividends, but I like the future growth that they are putting out. So if you take a look over here, you can really see the revenues starting to grow. If I go on a quarterly segment, you can see this shoot up in revenue over here is quite significant, and I believe they are expecting to put up around 60% growth in Q3 2026. So if you're pricing in the growth, Viper Energy might just be a better option. I think I'll have this fully fleshed out by tomorrow. I shouldn't have a problem with that. Let's take a look at this. So this is Viper Energy and their growth rates. So they are growing at, so they've been growing at around, accelerating growth rate 108%, 127%. Oh, this is, yeah. Is it 6? Where is June? Oh, June here. Okay. 124. So they're expecting to grow even more in Q3. Let's take a look at Texas Pacific. So for Texas Pacific, if I take a, I really love Fiscal AI. Yeah, I think they are a more stable company. I think what Kunal says is right. If you are buying Texas Pacific, you are really buying a high quality, strong compounder. If you're buying Venom, you're buying them for Viper. Sorry, you're really buying them for the growth. So there are a couple of things that I think I'll need to dive a little bit deeper into. Number one, the main difference in their assets between TPL and Viper. Second thing, in terms of the debt structure for Viper, whether or not they can continue funding this and how long they can continue funding this. I believe the divestiture of their properties in February and all that will close soon in the next couple of weeks. And then once that happens, that's an extra $600 million in cash that they can use to continue to fund their interest payments for quite a long while the sites turn profitable. That's the second thing. And then the third thing, finally, is to really understand the trajectory of that growth. Because like with SoFi and all that, it's very easy to understand the trajectory of growth if you just look at members and the member growth. But for companies like Viper and TPL, it's a little bit harder. So I just want to understand what is driving this growth and how long can that continue. But yes, I am definitely looking. Thanks to Kunal for reminding me about TPL. It came up during my research, but I barely paid attention to it. But this really does seem like a pretty strong compounder. I think people underestimate the strength of growing at 10 to 12%, 15% even, consistently for the last couple of years. So let's take a look at both, and then I will give you a full breakdown tomorrow along with UiPath, right? Okay, and so with that, thank you very much for your time. Today, everything is down. At least so far, it's no longer below 18. But like I said, I do expect a retest of 1750. So let's wait and see. And for Bitmine, we were up on the day. Right now, we are down. I think crypto is likely going to see some volatility if we get a broader market sell-off. So I don't expect crypto to be fully like immune, I would say, to the market volatility. I expect volatility in the coming months. I'm trying to sell aggressive covered calls to hedge the positions over time. And yes, and I will look tomorrow. Most of the stream will then be looking, creating a fundamental thesis around potentially hedging the portfolio using energy stocks like Viper, Texas Pacific. Fantastic call by Kunal. Yeah, because I'm not from, I don't really pay attention to the energy sector much in the US. So when I saw Texas Pacific land, it didn't occur to me that they are very similar to Viper, but it is a good call. It makes a slightly different, it makes a, yeah, it gives me a decision to make at least, right, between the two. I think I'm likely going to take up a position in either one. We will decide which one across the next couple of days. And then we'll talk about UiPath as well to prepare for upcoming earnings. Okay, so this is where this has to do with the divestiture of some of their properties. Okay, so they have actually sold off their non-Permian Basin assets and concentrated onto the Permian Basin, and they have cash coming in. So that cash is supposed to be able to fund their debt payments. I've looked into Q, haven't deep dived it yet. Yeah, my concern is that whether or not I'm getting too much exposure to the AI space. But like I said, you know, if there's not much new news tomorrow, I think tomorrow the only thing we are expecting is the FOMC meeting minutes. I think apart from that, we can spend more of, I mean, today we're talking mostly about macro, right? But I think for tomorrow's stream, we can spend most of the time deep diving into these companies. The Viper and TPL comparison would definitely be done by streaming time tomorrow. Then we might look into UiPath and Q tomorrow during on stream as well. Right. Thank you everybody for your time. I will see you guys tomorrow, same time, same place. Hope your stocks continue to stay green for the rest of the day.